Hello Sector Watchers, welcome to the show. This is the 115th episode of Sector Spotlight for Tuesday the 15th of February, recording it on Monday the 14th on Valentine's Day. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. If you want to get in touch, please use any of the handles on the screen. Remember, you can watch Sector Spotlight on YouTube or on any of the on-demand platforms on the StockCharts television. For today, we're going to look at the rotations for asset classes and sectors. We're going to pick out a few of the most interesting individual charts for asset classes and some sectors. And I'm introducing a new segment in the show. We're going to do a sector special. And for today, I have picked the consumer staples sector as the special. I hope you like it. And let's get started. There's no time to lose. On the right hand side we have the RRG showing the rotations of last week on a daily scale, and we see a lot of tails moving lower on the RS momentum scale and slightly to the left on the RS ratio scale, indicating that it was a relatively bad week. The two tails that are still on the far right are for commodities, so GSG and DJP. Despite the fact that they rotated from leading into weakening. If we look at the outright performance, then we can see that GSG picked up 1.3% while DJP picked up 1%. And that goes against a loss of 1% for VBINX, the benchmark that we use for this universe. And once again, for those people who don't know it, the VBINX is a balanced index fund which consists of 60% equities and 40% bonds. So commodities are not part of that benchmark. Nevertheless, commodities is an important asset class, and if you have a 60-40 portfolio, then commodities could be a very good diversifier to outperform your benchmark, if you are looking to do so, that is, of course. Now, another a good asset class was the dollar. Dollar picked up again. We've talked about the dollar index and euro dollar charts on a regular basis over the last few weeks. And more recently, the image became a little bit less clear. And I think that we'll have a look at the dollar index in a minute, that we sort of stayed on track. We went through a difficult period and it looks as if we're back on track, but we'll have a look a little later. Now, the asset classes that were underperforming last week, or at least that were underperforming last week, high yield, real estate, and SPY, the stock market. Stocks lost 1.8% versus 1% for the balanced index. And you can see that the tail of SPY moved into leading, but on Friday actually rolled over again. So basically that's what characterized last week's rotations, is that it was a pretty good start for risk assets like real estate and stocks, but Thursday, Friday wasn't that good, and especially Friday was a weak day for the stock market. I'm recording this on Monday, my daytime, so the US markets are not even open yet. It's about an hour before the US markets open, but European stocks across the board are showing declines of 2 to 3%. So, I'll be very surprised if we see a very strong stock market in the US today. But hey, what do I know? I think that we are in that period where a lot of people were talking about it, and we had a bounce of support. And we'll have a look at that chart later on. But it looks as if we're actually going to see a little bit more downside. At least in coming days, maybe even in coming weeks. If we bring that daily rotation to the left-hand side of the chart, that's where we find the weekly RRG, then obviously the strength for the commodity markets is clearly visible. If you look at the tails for DJB and GSG, they're the longest on the plot, and they're the strongest, and they push further into the leading quadrant. So no doubt that commodities is the best performing and the best asset class at the moment. Now, if we look at the rest of the asset classes here, then we can see the US dollar sort of flat for the last 2 weeks. You see those very small segments here. sort of stabilizing, and with the improvement that is potentially there in the US dollar index chart, we could see this tail moving further to the right on the RS ratio scale. Here is government bonds. They start to roll over inside improving. So does high yield, although it's very close, and this is, it's only one segment that starts to roll over, but we got to be aware of it. And then here you got corporate bonds that are actually, they hooked back, which is, especially in combination with government bonds, you would expect with the weakness in the stock market for bonds, and especially government bonds, to do well. We discussed the ratio of stocks versus bonds, and that seems to be moving in terms in favor of bonds at the moment. Although these tails are sort of sending a, I don't know, maybe a cautionary signal. Maybe it's a short-term rotation, I don't know. But it's kind of confusing because it starts to roll over here while the S&P 500 is still moving further into the weakening quadrant. So we've got to keep an eye on it. The stock's definitely still on a weak trail. If we zoom in on that, this is the weekly, so we zoom in on the longer term movements, and you can see that the segments are still pointing to that southwestern direction. And last week we sort of dropped vertically, probably because of the good start of the week. So it'll be interesting to monitor how this rotation will continue in this week when it really starts to move. Anyway, the bigger picture here is still weakness for stocks, strength for commodities, strength for the US dollar, and I want to say strength for bonds, but the last week makes me kind of cautious with that, and we'll just have to wait and see how that plays out. Maybe these tails will be straightened out during the course of this week, but we can only tell by the time next week comes. Now, a few of the individual charts. I already told you that the S&P, the stock market chart, wasn't too good. And I think what we're seeing here is a pretty good example of all support levels starting to act as resistance. And what I mean is this here. We see that long-term rising channel in the S&P 500. We broke that in January. We dipped to support around 420, 425. Then we rallied and we tested again. This is 45660. This is 45612. That's pretty close. That's close enough for me at least. Then we dip and we do it again. We test again for that's 45788. So twice we've tested. This is 458. So 458, 458, 456.6. It's about a point difference. So twice we now have tested that old support level as resistance. And it looks as if we're completing a double top here. So last Friday completed a double top. So look at, this is Wednesday, and then Thursday, Friday we fall off a cliff. So that's the strength that we see in those RRGs. And if this continues, the RRGs will start to pick up the weakness that we see here. So a double top completed on the daily chart for the S&P 500. That doesn't signal a lot of good stuff. I think it actually signals a renewed test of the area between 420 and 425, and we'll just have to wait and see what happens there. If we crack 420, 425, then obviously there's a lot more downside available for the S&P 500. If we bring this to the weekly chart, now we see a similar picture, but it's a bit cleaner. You can't see the double top formation that we just saw on the daily chart, but what you can see is that we rallied towards the bottom of that former support line that now starts to act as resistance. Again, for the weekly to actually acknowledge that a top is in place, we need a little bit more downside. But here you can see the damage that will be done when the S&P 500 drops below 420 support. So let's keep an eye on that. When that happens, we are probably in for a bit more downside. So 420 is about the first level on the downside that I'm going to watch. I said we're going to look at the dollar index, and here you see the dollar index in its channel, and we saw that those wide swings over the last 2-3 weeks, and now we just bounced off. It looks as if we're just bouncing off that support line here that's marking the bottom of that, or the lower boundary of that rising channel. The euro dollar charts that we spoke about last week, they're a little bit less clear. So let's see how this works out. Maybe the dollar index is a better, because it's a basket of commodities instead of a one-on-one relationship. But this still supports my view for a stronger dollar going forward. And the US dollar index here seems to be still on that track. Where are we going? Probably 97.5, 98. If we take that out, obviously there is much more upside potential. Now, if we quickly go to the stock market, we see government bonds here, which are continuing their downtrend. A bit of a bounce here last week. That's, you saw that bounce. That's probably causing that weakness here for those tails, the start of the week. But we're fighting back, and we'll have to say how that works out. But the image here for Gulf is definitely pretty weak, and you can see here, I didn't draw that line in yet, but I think that 25.80, 26 is the next, used to be resistance support here. You can expect it to act as resistance on the way up again. And a pretty similar picture is working for IEF, the 7 to 10 year Treasury bond ETF. Big head and shoulders that we completed. We pointed that out last week. We're still on track for a move, which actually suggesting much lower levels, much higher yields for Treasury bonds. And then finishing off this section for asset classes with the charts of DJP and GSG, both still well underway for more upside after they broke heavy overhead resistance levels. Moving over to sectors, we have the rotation of last week on the right-hand side on the daily RRG, and we have the weekly rotations on the left-hand side. If we quickly go over the performances of last week, then we see that once again the energy sector was leading with a gain of 2.2%. And on the opposite side we had technology losing 3%, so that's a dispersion of about over 5%, 5.2% between those two sectors. On the good side of the equation last week were materials gaining 1.1, financials unchanged, industrials losing 70 bips, staples losing 80 bips, healthcare losing 1.5%, and then comes the S&P 500 with a loss of 1.8%. That means that utilities, discretionary, communication services, real estate, and tech were all underperforming and below the performance of the S&P 500. If we go over the individual tails, then we can see obviously that the energy sector is way to the right. That's the characteristic of the last few weeks. Energy being sort of disconnected from the rest of the sectors with strong performance, and we can see that the tail here suggests that energy is going through a small pause. We came from leading into weakening, and you can see that over the last 3 days, energy is descending in velocity. That's the difference between day-to-day observation. So these segments are getting smaller, and now we see a small turn up for the energy sector, way ahead inside the weakening quadrant, way above on 100. So there's a very good chance, very good opportunity for energy to curl back up and start moving back towards the leading quadrant again. Another sector that did well is financials, probably on the back of that interest rate move that we're seeing. Bonds are coming down, yields are going up. That's usually a good story for financials, and we see a very short tail here, which indicates that it's a stable trend. It's on the right-hand side, so it's a stable relative uptrend versus the S&P 500. And we still have the healthcare, utilities, and staple sectors doing okay here on the daily. The healthcare is dropping, but it's still on the right-hand side. We have utilities, which similarly went from leading to weakening, and we can see that it's now just about to roll back up. Not sure whether that can curl back up without hitting the lagging quadrant, but the strongest negative bit, the weakest momentum, seems to be fading. And now we have staples, which is kind of a similar story. You see that we had that move into weakening, and it's now starting to carefully start to curl back up. So that's for the defensive sectors. Now, if we look at the communication services, that is a sector that's been doing really, really bad over the last few weeks. It was already inside the lagging quadrant, and it's now starting to push further to the left. And if we look at technology, that had a bit of a hiccup, but at the end of last week, we all know that tech was hit hard, and you can see that translated into an almost vertical hook down on the daily tail for the RRG. We're going to look at how that looks on the weekly in a minute. And then finally, the discretionary sector going through a recovery on the daily RRG. So that tail is predominantly momentum driven to the upside. It's picking up a little bit of relative strength, RS ratio. We'll have to see whether that can continue. Now, if we bring all of this back to the weekly RRG, where we can see the longer term relative trends, then obviously energy stands out with that super strong tail moving into the leading quadrant. So there's no doubt about it that energy at the moment is one of the, if not the strongest sector. That also goes for financials. We already noticed last week that it was moving into the right direction, pushing into the leading quadrant. That move is now continuing. If we look at staples, it lost a bit of momentum, but its staples are stable, moving almost horizontal, slightly angled up, so it's picking up on the RS ratio scale, means that that relative trend is still doing well, it's still there. We see healthcare, it's not that strong of a trend, but it's inside improving, very close to crossing over into the leading quadrant, so that's still doing well there. And utilities are inside leading. They lost a little bit of momentum, but again, they're still in the defensive area and above the S&P 500. Stuff that's doing not too well. You see materials nosediving inside the leading quadrant, vertically down. Technology is continuing to move into that southwestern direction, suggesting that there is further relative weakness ahead. Industrials not doing much. It's at a good heading, but it's inside improving. But look at how short that tail is. There's not a lot of power behind that move. Real estate is rolling over, just starting to head towards the weakening quadrant. So that's not all the best tails that you'd like to see. And then here we've got communication services in a hiccup move, pushing towards improving. But look at how far that is detached from the 100 level and the rest of the sector. So that's still a very weak sector, especially if you combine it with that weakness on the daily chart that you can see there. And then finally we have the discretionary sector now finally pushing into the lagging quadrant on the weekly RRG. And we have that weakness obviously inside the, the weakness is on the weekly, pushing into the lagging quadrant, and here we see that hiccup. So if that tail here on the daily RRG starts to roll over, it will start to add negativity to the weak tail on the weekly RRG, where discretionary is now pushing into the lagging quadrant. Now, I want to highlight a few of the individual sector charts, not all of them. One of them, of course, is communication services, because this sector is really taking a beating recently. It looks as if it's going to continue to do that. I mean, we talked about that hiccup here, but it looks as if we're now breaking below, the previous low. So it's confirming that series of lower highs and lower lows. And look at that relative strength that's starting to drop down. And the RRG lines are still digesting that small sideways move here. But I expect that this green RS momentum line is starting to roll over soon and keep the communication services inside and deeper inside the lagging quadrant. Energy is the opposite. Look at the nice base breakout here for relative strength. That is still there, it's still going strong. It's pushing both RRG lines up. And if we look at the break here, that's a very clear break. And you can actually, if we bring this to an even longer term history, then you can see how nice that breakout is, and that we're actually probably going to challenge that 75 peak that was set at the end of 2014. Again, breaking that upwardly would be very, very nice, but look at the turnaround that we see here in terms of relative strength. I think that's a very significant move that we're currently experiencing. Now, here is the financial sector. It's now back. We had a bit of a problem here, a bit of a confusing whether it's going to break or not. Looks as if that lower boundary of that channel, it's not that clear, but I think it's still there. These major lows are still higher, so it's confirming that uptrend, and I think that we're now clearly breaking that overhead resistance in terms of relative strength, which can push the financial sector higher and deeper into the leading quadrant on the RRG. Technology, just like the S&P 500, a very good example of old support now starting to act as resistance, and it's sort of a double resistance because we had old support from the rising trend line. That was broken and got back as resistance, and we had the old support from that previous low that was broken and now got back into resistance. So assuming that this is now a high in place, it'll be very difficult for the technology sector to keep up above that support level inside the relative strength area. If that's going to break, and the RRG lines are already anticipating that, I think we will see more relative weakness for technology in the coming weeks. We go to staples. Consumer staples is obviously one of the more stable and defensive sectors. That uptrend is fully intact. There's actually a little bit room to wiggle within the boundaries of that trend channel before that breaks, and the direction and the turnaround and relative strength is very clearly visible. It's pushing both RRG lines up and the consumer staples sector further into the leading quadrant. And then finally, we're going to wrap this up with discretionary. Here also, old support turning into resistance, double resistance as a matter of fact, just like tech. Also the old support line from the channel, as well as the former low, former two support levels now turning into resistance. We're going to look at, this is about 170, a little bit over 170 as the next support level. If that breaks, then there's more downside to be expected for the consumer discretionary sector. For the time being, the relative strength is still inside its range. Be careful when we break below that August low in relative strength, because that'll signal much more relative weakness for the consumer discretionary sector. And again, the RRG lines are looking to anticipate such a break. Now, with the staples sector moving further into the leading quadrant and obviously being one of the more defensive sectors while the market is under pressure, I think it makes sense to look at the staples sector in a little bit more detail and break it down into the groups that make up the consumer staples sector. And that's the RRG that I've done on the right. Now, this RRG is positioned against the S&P 500, so no wonder that you will see most tails moving into the top right-hand corner, into that northeastern direction, because the sector as a whole is good and at a relative uptrend versus the S&P 500. So this is what you would expect. But it also shows us immediately that at least one of the groups here, that's FD, that's the food retailers and wholesalers group, is something that is probably better avoid inside this sector, because it had its run, it rolled over, and it's now moving into the weakening quadrant. There's actually a few others that are starting to show some sign of weakness. So this is non-durable household that's starting to roll over. This one is actually doing very good. Tobacco, drug retailers are good. Here you see food products are good. You see soft drinks are good. You see distillers and vintners are starting to roll over. And here we see consumer products, personal products are starting to roll over. So already from this point of view, we can pick out a few sectors that are probably better avoided. Now, an even better image you will get when you take those same set of groups and position them against the consumer staples sector, so against XLP. So now it's the same set of groups, but they're now visualized against the sector index. So this brings out the groups that are doing well versus a sector that's already doing well. And if we browse through here, then we can see that, again, non-durable households is not where you want to be. Soft drinks are right in the middle. That's probably because Coca-Cola and PepsiCo are the biggest stocks inside the sector and inside this group. So it's not a surprise that this industry group is very close to the benchmark. Doesn't give you a lot of opportunity to outperform the consumer staples sector. It gives you the opportunity to outperform the sector, but not necessarily the group. So where do you want to be? So here is brewers. They're doing well, but they lost a lot of their momentum that they had. Tobacco is on a roll. That's a very good trail. Drug retailers are doing well, although the distances are getting smaller, but it's pointing in the right direction. Food products rolled back up, jackknifed back up, and are now heading towards the leading quadrant, and they're doing nicely as well. Again, food retailers, distillers, probably better avoided. So the good stuff inside the consumer staples sector, which in itself is already doing well, is brewers, maybe not so much, but definitely tobacco, drug retailers, and food products. Those are the three groups inside the consumer staples sector that I'd pay a little bit more attention to. And that concludes Sector Spotlight for this week. Thank you for watching. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. You can watch on YouTube or via StockCharts television on any of the on-demand channels. I'm looking forward to see you again next week, same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.